Welcome to Financial Caffeine, retirement clarity, tax smart strategy, and real structure without the BS. The 10-year rule for inherited IRAs is one of the most destructive tax rules in retirement planning, and it's catching families completely off guard. In 2020, Congress changed the rules on inherited IRAs. They took what was once a 30-year tax strategy and turned it into a 10-year tax crisis. This affects adult children, spouses, siblings, anyone inheriting a 401k or IRA. And most people don't know it until it's too late. Today, I want to show you why the 10-year rule is blowing up families financially and how to avoid the disaster, or mitigate it at least. Now, if you inherited an IRA today and you're not a spouse, you must empty the entire account by December 31st of the 10th year after the original owner died. Not stretch it, not pace it over 30 years, not delay until retirement, not let it grow tax deferred indefinitely. You have exactly 10 years. Here's the problem. Most people wait. They're emotional, they're grieving, they don't want to touch the account, or they don't really know what to do with it. This rule is dangerous because it affects, one, your tax bracket. Inherited distributions stack on top of your existing income. Two, your IRMAA premiums. Inherited distributions raise your taxable income, triggering potential penalties. Three, your Social Security taxation. Inherited income can make up to 85% of your Social Security taxable. Four, your Roth conversion windows. Inherited income eats up your tax bracket space. Five, your financial aid, your FAFSA. If you have kids, college planning gets hit hard, which is exactly what happened in one of my clients' case. Six, your retirement timeline. People in peak earning years now have to take forced income. In other words, the 10-year rule forces income into the worst possible years of your life. So let me talk you through a real scenario. A woman we met with inherited a $740,000 IRA. She and her husband are teachers, 2 kids, busy life. They didn't want the IRA income to affect their FAFSA forms for their oldest child, so they waited 4 years before touching it. But here's the problem. They now have 6 years left to empty $740,000 on top of their teaching salaries, plus potential raises, plus other income, plus Social Security taxation interaction, plus IRMAA exposure once they retire. This isn't a distribution plan, it's a ticking tax bomb. They didn't do anything wrong. They just didn't get direction early enough. Let me show you what waiting looks like. If you wait, taxes stack, brackets explode, IRMAA triggers, Social Security gets hammered, Roth conversion windows shut, and beneficiaries get crushed. Now, instead of $740,000 over 10 years, which is approximately $74,000 per year, it's $740,000 over 6 years. That's $123,000 per year on top of your normal income. This is what crushes middle-class families. You don't solve the 10-year rule with a guess. You solve it with architecture. Step 1, you build a 10-year tax map, year by year bracket engineering. Step 2, create a distribution ladder, strategically withdraw during your lowest income years. Step 3, offset withdrawals. Use charitable gifting strategies or other tax levers if appropriate. Step 4, integrate IRA withdrawals with college planning, Social Security, Medicare, Roth conversion, retirement timeline. Step 5, avoid the wait and panic approach. Waiting leads to bracket explosion. Action leads to control. And step 6, if it's an IRA you don't need and you have additional liquidity, there's opportunities for some advanced strategies to move it off the radar. Now, if you've inherited an IRA or you know you will inherit one, we can walk through a full 10-year planning framework simply by having a clarity session that's completely free to you. No jargon, no commitments. Leave your wallet at home. It's free, it's clear, and it'll save you from painful tax mistakes. You can schedule with us below. Be watching for my next video, The Truth About Annuities. Nobody tells this part. Subscribe for weekly retirement clarity and grab your spot for the free financial caffeine workshop in the description.